It's a flat start for benchmark indices. It's a good start for the market breadth once again. No large news makers over the weekend, so it is pretty much an extension of what we, let's say, saw last week. In terms of the real gainers, we've got well, not too many gainers actually are popping up. You've got railway stocks which are popping right up there. You've got all the at PSU railway names. I think they're off to a great start. So I think that is empirically visible in terms of the market gainers. Pratap Snacks block deal 6% higher. There is Tata Investment Corp. This is one of the holding companies of Tata Group, which has a lot of stocks of cross companies. Actually, one day we'll analyze the holding of Tata Investment Corp, but 3% higher on strong volumes. Tata Tech goes public. They must have some cross holding there, I'm sure. The other odd one out today, I think, is Nykaa, which is trending up on strong transaction and strong volumes. So is the buyer back in Nykaa in terms of the market? Now let's look at the NBFC space. Piramal, Bajaj, Aditya Birla. What is the trend there after Reserve Bank of India, directive? So Bajaj Finance 7200 plus. Aditya Birla Finance, it was down by about 5-6%, I think, on Friday. That one is making a comeback. And then if one really looks at Paytm, which in a sense also will see an impact because growth may just slow down after RBI directive, that is also stabilized. But I think it's a breadth, which for me is the talking point, and the breadth again is looking absolutely stellar.
Oh yes, indeed it is, and a handful of other stocks as well that will remain in the spotlight. You've got brokerage notes as well that have come out on Honasa Consumer. There's also on a Paytm with respect to the latest updates and news. So those are some of the stocks as well that will be closely eyed. And other than that, just checking in on the broader markets, it's pretty flat, a mild positive bias. You've got the index which is quoting at about 19,728. Names like Axis, Asian Paints, Kotak Mahindra Bank, those are taking a bit of a backseat. Let's check in on some of those railway stocks as well. And the NBFCs continue to remain in the spotlight. Bajaj Finance, AB Capital, etc. all in focus in trade today. L&T Tech, they've signed some sort of a tie-up with Nvidia. That stock as well is up in today's trading session. And on the back of brokerage notes, you've also got our Indian Hotels, which is at about 412. Tata Investment Corp, EIH, Procter & Gamble, Sterling & Wilson, Star Cement, NMDC, Ircon continues its up move. These are some of the stocks that are active in trade. But what are the first trades from our chartists? Let's find out. And Kunal, what do you make of the market open and your first trade?
So again, not surprised by the slight underperformance of the banking index, which is down 100 points as compared to the Nifty, which is absolutely flat. In terms of opening trade, I would look out for Hero MotoCorp, a stock which I think on Thursday as well as on Friday give a strong breakout. So that's a stock which I'd be keen to buy, even if there's a mild kind of a correction.
Nuresh, what about you? What would your opening trades be?
So defensive trade here, Hindustan Unilever tried to make a move on Friday. Has consolidated well around the 2480, 2500 mark. So a good risk reward here for a bounce back trade.
Right, HUL it is, and Kunal is looking at a Hero MotoCorp, so clearly some of the large caps in the spotlight. Well, let's hear it out then from Saurabh Mukherjee of Marcellus Investment Managers. He talks about a whole host of sectors and stocks like Trent, HDFC Bank, Cera Sanitary, Bajaj Finance and more. Listen in.
So look, I think I wouldn't lose too much sleep about the RBI rap on the knuckles. My reckoning is it's at the most going to impact around 2% of Bajaj Finance books, and if the Bajaj BAF management expeditiously deals with the issue, the impact on full year profit should be hopefully less than 1%. So it's a rap on the knuckles, as you say, but I'm not so sure it's that big a material impact on their FY24 profitability. I think the central bank should be lauded for trying to cool off the personal loans mania that had gripped India over the last 12 months. We were going bonkers as a country doing this personal loans business, 30-40% loan book growth in many places. We'd written a note about it for our clients around a month back saying this is getting overdone in India. Credit to Bajaj's management. BAF said in its Q2 results around 3 weeks ago that they were already pulling back on personal loans. So credit to RBI. RBI's move yesterday, I reckon, will increase cost of funding for NBFCs by around 50 bips. Bajaj is well capitalized. They've raised another fresh round of capital recently.
All right, Ajay Srivastav joins us. Ajay, good morning. The match got over by 10 o'clock. You were running late. Was it a late night even though India lost?
Yes. I think it was a late night because we had to drown our sorrows. With all the expectations, all the celebrations ready, the champagne had to go back to the cooler, and we had gone back to the old thing to say, "My God, once again." It was deja vu for me because I was there for the South African finals, watching the match there when we got hammered. So I think I've decided I will not watch any more finals again. Maybe I am the jinx person.
I love the Times of India headline today that one head broke 1.2 billion hearts. I love that
I
line.
know. It's second time over for us, so I think maybe in this life we'll never see a World Cup up in our hands, but I hope so.
Kids are doing very well, so you should be happy.
All the best to the guys. I think it was sad. I think it was sad because we didn't fight. And that's the point I say, you lose, but you fight. You don't hit a 4 in 20, 30 overs in a one-day international. It's bizarre to say the least. I don't want to criticize, but this is not what we paid for yesterday.
But markets are doing well, Ajay. So I think there is reason to smile. I mean, we've just done much better than what everybody thought at the beginning of the year.
Well, yes, answer is yes. But if you look at the vast majority of people who have got invested in the large cap funds, who got invested in the banking fund, I think for them it's not been a good year at all at this point of time. So yes, there are a big pockets of market which have done reasonably well, or quite well, or exceedingly well in that order in the mid cap, small cap. But if you look at the vast universe of money invested in the large caps, that's been a very, very disappointing year for them. And we keep saying it's going to repeat itself next year. And that's the sad irony that a large portion of funds of retail public are not making even a decent return. So yes, the general market has done very well for most investors. Most PMS portfolios have done extremely well. Individuals may have done extremely well. But I think the general public, which are invested in large caps, I think had left disappointing. And you've seen what's happened to the banking index in any case. So I think, you need to bifurcate the market saying exceedingly well, very good, and very, very disappointing. Large caps have been part of the very disappointing bucket.
So where are you picking your spots? Are you going back to large cap and say that disappointment means value and excitement means no value? So small cap is exciting but no value. Large cap is disappointing but there is value.
Well, I don't know how to say this, but it's very difficult to find value in today. India is not a value market. Everything is expensive at the end of the day. So you're really buying momentum. You're buying PE expansion at this point of time. You're really very, very few, far between. You will find a value stock. You may consider the PSU bucket to be the value stock because those are the only ones in single-digit PEs and decent cash flow, etc. But really speaking, across the board, there is no value in this market. This market is about momentum investing. This market is about new stories coming out. This market is about government spending themes. So, I think you'll be waste your time if you buy value in this market. Value can go on forever, not recognized. And really speaking, at P's of 25 and 30s, except for banks, I think you're really difficult to find value. So forget value. Nikunj, I would say this year, next year is going to be back to momentum investing and wait for corrections when you buy. What you buy at will dictate what you make, not what you kind of keep adding up and so on and so forth. So value concept out from Indian market. We are expensive market.
Ajay, when you're referring to that PSU pack, which is cheaper, which ones are they? Is it just the bank part you're referring to, right? Because it can't be railways or defense or even power utilities have run up quite a lot.
Yeah, even after they run up, let's take the metal stock, let's take even the power utility stock, let's take the transmission stock. I think in comparison to their NAVs, in comparison to their book values and the rest of the market, they're still significantly cheaper. Yes, they have run up, you're right, absolutely correct. But the fact remains, compared to the rest of the market, this bucket is still quite cheap. Now, yes, it has not done really well in the last decade or so, but things do change, happen. Dividend flows have become much higher from these companies. So that extent is much better for investors. And, I keep saying, there's Hindi mein kahavat hai, mara hati bhi sawa lakh ka hota hai. So how bad can they get? If they get bad, you buy more and so. So I think as a bucket, whether it's transmission stock, power stocks, metal stocks, the material stock, commodity stocks, and of course the PSU banks, you name it across the board, the valuation is significantly cheaper than the rest of the market. Now, that would give you better return. I hope so. Higher risk, certainly so. The only one we don't want to invest in is going to be refining companies because they're not really companies, they're government departments. So you don't know what you're going to make out of them. So I think apart from the bucket of the refining companies, rest, I think entire lot of PSU is still a pretty cheap lot compared to the rest of the market.
Okay, morning Ajay. Let's get in your
Good
take
morning.
as to what you make of the entire new age tech basket. Given that now you have a lot of these companies that are focusing on profitability, have really pulled up their socks in a certain sense. Is this a sector that merits a relook? There's so many IPOs as well that are hitting the market. Tata Tech, for instance, will be closely eyed this week. Your take?
Oh, that's the beauty of this market. And I think that's where the Indian investor need to go. And, we have told our team that in the matter of, we should have more than 50 to 60% investment money in companies which are less than 3 to 4 years on the bourses. I think that's the more important one. There's so many new themes coming out in the market. These have got new age ability to harness large number of customers at a very short cost base, don't need to physically expand. So, it is given that if you're not having in a portfolio these new age companies, I think you're missing out on the big ride in the market. You want to allocate still to the cement stock or HDFC Bank, you can do at your own risk. That's really not the way you're going to invest in the next year. I would still recommend new age has also come with monopolies. If you see whether it's payment systems, food delivery companies, advertising companies, lounge companies, you name tech companies, defense companies, all of them are in semi-monopoly or monopoly status. And this can't be built over time. The cash burn is by and large over at this point of time. Most are at least EBITDA positive. So you're really coming in at a time, yes, they have run up quite a bit. To be fair, most have doubled in the last 6 months or so. So you go to pair your investments. But if you don't have more than 50% of your investment in new age companies, I think you'll do injustice to your portfolio. The old companies need to be given out of your portfolio. It's like your old wardrobe. You need to take out your old clothes out of a wardrobe, right? Don't take out your old men out of your homes, but at least the wardrobe out of your homes and substitute with the new latest ones. That's what the portfolio is all about. Button is refresh at this point of time, not to go back to pedigree stocks.
Antique paintings, antique cars, vintage wine, everything old does well, my friend.
See, you are a rich guy. That's why you talk about antique wines and antique, 40-year-old, 50-year-old scotch. I'm talking of ordinary people like us who like to just focus on wardrobes. If we can afford more than that, we are lucky.
My friend, it is just that I don't have money. That's why I don't change. And because it is I don't have money, I don't change becomes old. It's the other way around.
No, I think you're right in a manner of speaking. But as I said, some of our older companies, look at what HDFC Bank has done. The biggest destroyer of wealth for the merger in the company, for the best known company. Just see what a protection of RBI competition can do to an industry. Banking is one such. The moment the umbrella of no new licenses went away, you see the true performance has come out. And it's a disaster. The banks are a disaster in India, absolutely. The quality of service, pathetic, absolutely. And, it's sad to see what's happening in the Indian banking industry when on one side automation is building up, but the customer service is collapsing at the end of the day. You must have read about the attrition levels. So, these are big behemoths. They ran their run because of the protection of RBI. You don't get RBI protection. These banks have come out to be true what they are. They are poorly performing companies at the end of the day with poor managers who got themselves rich by ESOPs at the end of the day. That's what these companies are. So I would say, go for the new guys. You got greater hope, greater excitement, and greater thrill of working on new sectors. As you rightly said, look at the number of IPOs in this country. Fantastic, absolutely. Look at the choices we got. Superb. So why would you go back to the old order? Do not, I recommend.
Let's look at something which you will say, okay, I want to buy this stock and I'm just waiting for a better entry point. It could be 5%, it could be 15%, it could be 20%. That's a judgment call. But which are the names where you think that the business is durable enough to give you a 20 to 25% growth? That is, you're just waiting for that right price, maybe that moment of panic or that moment of turbulence in the market, and you're happy to press the buy button.
See, very clearly, the MNC infrastructure stocks, the 3 or 4 of them qualify in that category straight away. You want to be there in the company because you haven't underinvested. Number 2 is certainly the companies like the payment system companies, certainly the food delivery companies. I think the runway for these companies in both infrastructure for relating to railways infrastructure relating to power systems, infrastructure relating to the general build-up of the economic assets, including transmission assets. Those are the sectors where the growth runway is incredible. So that's one. Number two is, if you look at the monopoly of the payment system company, one company. If you look at duopoly of food delivery, two companies, and they will not become food delivery anymore. They'll become advertising companies like US has become. Phenomenal entry. I think that's the new delivery, the retail companies which are coming out. I think those are fantastic companies, which if you get a price reduction, you go buy those companies. So I think these gamut of companies is one way would do it. PSU defense, yes, if they correct significantly, we would add on to it. We already hold the stocking. But yes, we would like to do it, but they're very, very expensive. But at any point of time, I still believe that the PSU companies in defense represent the best and the worst opportunity. Why I say best? The runway is unlimited. Why I say worst? One government decision which says that you will not get 14.5% margin or 12.5% margin and 6 from here and onwards from the order from defense industry, the whole fortune of the company changes. So please understand, defense companies represent the best opportunity because the runway is unlimited and there's monopoly. The worst, because one government diktat on what they make on every order can change the fortune of the company. High risk, high reward, I think it's poker at best.
QSR, there was a lot of interest in the market, and understandably so, because the numbers were supportive. But last 1 or 2 quarters, we are witnessing the darlings in the QSR space, Westlife, Jubilant, all of them getting a knock on their QSR, the rate of growth. And hence, some of them started looking slightly expensive. Do you like that business at current levels, or some of them?
We have no investment. No investment thesis. The competition from cloud kitchen is enormous. Nobody wants to go out and eat at a McDonald's. Maybe a kid once wants to eat it. At the end of the day, you don't eat at a Pizza Hut. You got so many gourmet pizzas available. I think those people have lost the plot in India at this point of time. Number one. Number two is the overestimation of market. In a country where almost 60-70% of people need to be fed food grains free of cost to survive, how big is your market for the QSR? And look at the pricing of those products. When they were cheap, they were good. When you price them the way they're priced today, you're taking it out of budget for a whole amount of the community of India and the consumers of India. So I think they were a darling at one time because, one, they promised that we'll access a large market. The pricing base of the products was much more cheaper than what it is today. With today's prices, they have narrowed down their customer bucket, and that is showing up. Cloud kitchen on top, home delivery on top, their goose has been cooked. So I don't think there's a great future there for a long time to come, given the fact they compete for retail space in malls, which is expensive. At the end of the day, the retail expensive, the maintenance cost expensive, people cost expensive. So they have a troubled life, I think, in the next couple of years because the cost is working against them. The consumer dynamics is working against them. They're fighting a consumer trend on a higher cost base. And that's why I think they will continue to underperform.
Has been cooked. Wow, what a lovely way of putting it, I would say. Ajay, tell us about you repeatedly mentioned transmission business and transmission towers and some PSU companies in the power space. PFC, RFC variety, even after run-up, has under one-time book. Have you looked at this recent IPO offering which is out there, IRIDA, the renewables, NBFC, or even Tata Technologies for that matter? Would it interest you?
Well, of course, see, PFC, etc. I can tell you one thing. This is what Nikunj was saying when you want to wait to buy. Not many may realize that PFC was less than 100 rupees with a dividend yield of 14% less than a few months back. I think that's an honest fact. All right. So, and we hold the stock for that disclosure purpose at the end of the day. And we held it for dividend limitedly, not for capital increase. Again, back to the point. These are monopoly stocks of power finance. No bank can afford to fund it. Nobody. If you want to set up a power plant in this country, you go to these two companies, REC and PFC. There is nowhere else to go. IRIDA falls in the same bucket, absolutely. Monopoly status, government guaranteed, ability to access funds, ability to access global funds, green funds, is perfectly positioned for the right amount market where the green is truly green for even investors. So I think you are perfectly positioned to go for the IPOs should you be lucky to get it. The problem has been few IPOs like Tata Technologies, maybe one out of a family member may get it. So we don't even make an effort to put our family money in these IPOs because if you don't have institutional allotment, we don't do it. Because how do you get these shares? Now, when it lists at what price, we will see. But answer is yes. You got to be really lucky. Look at the lucky stars and apply for the right time on the Muhurtam. Don't apply in any other wrong time, and you might get it. So if you get it, you're lucky. If you not get it, wait for a time to get in. But both are good stocks.
All right, Ajay, always wonderful having you on the show. You just light up the conversation over here. Thanks very much
Thank you
for
very
your
much.
time today.
You're kind. You're kind. Thank you. Have a good day.
All right, so one part of the market which is being punished for last two trading sessions, and that is areas of the market which market thought are getting heated up for consumer loans, unsecured consumer loans in particular. Select banks too have reasonable exposure there, like RBL, etc., and are under pressure for a second day running. Vishal Goyal of UBS is joining us now, the head of research at UBS, to talk more about that. Vishal, good morning. Thank you so much for your time. You analyze this space pretty closely, and RBI did kind of drop hints in multiple platforms about the way unsecured, especially consumer loans, were getting scorching, growing at a very scorching pace, and now they have moved. How much capital requirement or the slowdown in the growth these names would have to see before they normalize?
Sure. So see, now one is a direct impact on tier one, which we estimate would be anywhere between 30 to 50 basis points, depending upon which bank we're talking about. That's one direct impact. Second, I think there is an indirect impact of increasing risk weights on lending to NBFCs, which increases the cost of borrowing for NBFCs effectively. And therefore, it will also have an indirect slowdown impact on overall consumer loans. If you look at the last 4-5 years, this segment actually has grown at around 27 to 30% CAGR roughly for the system. Now, with increasing lending rates, we feel that they should slow down a bit. Now, if you assume a 5% slowdown of this segment, that basically would mean a 50 basis point slowdown for the system credit growth, considering this is now becoming around 8 to 9% of the system credit.
Vishal, is this like a canary in a coal mine? Because Reserve Bank of India has access to more data than what perhaps you and me have. So is this more like a profit warning by Reserve Bank of India saying that guys go easy because we don't like the way you're lending?
Looks like. I think clearly regulator seems to be ahead this time on this particular segment. And as you rightly said, they probably are seeing more data. Some data we have also highlighted in our last report, which is the new disbursals are increasingly going to weaker borrowers. And that probably, could be the warning sign which even RBI is seeing. While if you look at purely the delinquency data, it is not suggesting huge alarm. Probably also, helped by the increasing denominator.
So Vishal, from a market standpoint, do you think now we can categorize the financial pockets into two, banks and NBFCs which have a high unsecured loan book and which have a low unsecured loan book, and the ones which have unsecured loan book and which have been growing higher than industry because of their growth in unsecured loan book, that bucket now becomes the bucket you want to avoid?
Yeah, I think, and that is what is our call as well. So you would see three types of players now in this segment. One, non-bank finance companies who are purely or majority doing unsecured lending. They are most impacted. Then we would have some banks who do unsecured and who have just entered unsecured, and because of their own cost of funding constraints might have taken additional risk. So these two segments would be more impacted. And then there is a category of large banks or top banks, which also we categorize, who have historically been doing this business and have been taking less risk even within unsecured. They would largely be unimpacted from credit loss point of view. But I think slowdown we would see almost everywhere now. That's how.
What could be the net impact according to you?
Sorry, I
no,
missed
the
that.
the net aggregate impact according to you, because now it's almost everybody's taken for granted that the system growth would be anywhere between 13 to 15%. Are we looking at, let's say, 1%, 1.5% getting knocked off at the industry level?
So our current estimates actually are kind of baking that in as well. So if you look at the last reported data, it's almost 15.9%, YOY loan growth. We are working with more of a 14% loan growth for this year, and which would also slow down another 100 bips or so next year. So we are kind of building in some slowdown in this segment.
What about the view, Vishal, on net interest margins, which were already in a bit of a consolidation phase and banks were already adjusting for high interest rate deposits? On the back of this news, what is it that you're expecting from the net interest margins going forward? Because the unsecured loan growth will likely get impacted.
Yes, so there is this positive loan mix effect of unsecured, which has also helped overall banking, NIMs going up. So the positive impact would slow down. I don't think unsecured would grow lesser than industry growth rates. So to that extent, I don't think there's a negative impact, but all the positive effects of improving loan mix will stop to come through to NIMs. There are other forces right now, which is, for example, rising cost of funds due to rising, TD rates or repricing of TDs. That is still, I think, is not fully captured in the margins. Plus the declining CASA ratio, which is, started since March 22 with the rate cycle. That is also, in a way eating away margins. So those two factors might be slightly more powerful. While I agree that the positive effects of unsecured also likely moderate.
Vishal, going forward, what's your take on credit cycle? Because there is one pocket of the NBFCs which are guiding higher for growth, because they are actually catering to that part of the economy which doesn't have access to capital. Yes, it is definitely risky. And even the India's largest bank like SBI the other day on Friday did sound very confident of at least 13 to 14% growth. So, which end? How will you balance out both the parts?
See, now we are not worried about systemic risks or even systemic, cycle wise, because like if you look at the last 10, 20 years, bigger problems have come from corporate cycles, just because of chunky in nature, and also we have and again regulator actually has acted much faster in unsecured case. So we are not expecting a big cycle of NPL or credit losses which will slow down the system. It's just that the new pockets of growth is being actually unsecured, and that would slow down, and that would lead to an overall slowdown in loan growth. We need to see a decisive pickup in the capex story. So like compared to previous cycle, we are not seeing long gestation projects or projects which are extremely capital intensive. So we are generally seeing light capital kind of projects being taken up. So we would need some capex demand which actually adds to credit growth. That would continue to, I think, generally support. I think the whole deleveraging cycle seems behind us. So that also is leading to slightly better growth numbers now. Our view is that given India's credit penetration, given where we are in terms of long-term cycle, loan growth should be faster than the nominal GDP growth, over 5 to 10 years period. And we are again in the right spot purely from a deleveraging point of view as well.
So Vishal, if the unsecured or the personal loan category slows down, do you think the NIMs also will be affected? Because this is one category where, in a sense, okay, you're taking a higher risk, but your spreads are always the highest.
So NIMs, as I was saying, so majority of banks actually have seen NIM expansion, right, in the last 4 or 5 years. And unsecured segment has contributed to that. Now the mix change actually has been positive so far. I don't think mix change is turning negative. It'll be like neutral. So for example, unsecured may grow at 15 to 20%, and system will grow at, let's say, 13 to 15%. So even, so it is slowing down from 30% to more like a 15, 20%, still faster than the industry. So what I feel is that NIM would be more driven by other factors than the loan mix. and positive effect of loan mix will not be there now. So very minimal.
So let's look at the environment now. Vishal, in last 1.5 years, we've seen a steady uptick in interest rates. That upcycle is behind us. We've seen a steady rise in decline in credit cost for the system. We've seen a steady decline in terms of where the NPA cycle has moved. So next 12 to 18 months, what kind of scenario do you think we are in? Because considering the scenario, then we have to choose the banks or NBFCs which will benefit, because banks are always a very macro kind of a trade.
No, absolutely. So we are still in, I would say, if I have to break it into 5-7 year cycle, we are still in the positive cycle for banks with no major risk on credit losses. I think the points we are trying to highlight is versus expectations, because what lowest credit cost is already in the expectations, in the numbers, consensus estimates as well. High NIMs are also been already reported and therefore are also part of expectations. There is some disappointment which would happen on both this leg. That's what I think we are highlighting, and therefore there is a mismatch in expectations versus what actually we might see. So there is a steady ROA expansion which has happened in the last 4 or 5 years due to the factors you just mentioned. We feel that we are probably closer to that expansion, like peak of expansion, and now we should start seeing some contraction due to NIM stagnating or declining and credit cost already bottoming. Now we would only see some increases in credit cost towards the average.
All right. Thanks very much for putting all of those details in perspective and better understanding the new lending norm details from the Reserve Bank. On that note, we'll take a very quick break, but don't go anywhere. When we return, we connect with the management of Sula Vineyards as we talk a little bit more about what drove growth in the quarter gone by. Thanks for staying on with us. A quick check-in as to what the market is up to, and as of now, it continues to remain status quo on the index. It's the broader markets as well that seem to be in a bit of a limbo in today's trading day. M&M, Axis Bank, L&T, Adani Enterprises, those are some of the stocks that are on the back foot, while Divi's Labs and its by and large IT, Tech Mahindra, HCL Technologies, Wipro, Infi, all leading from the front. But yes, Sula Vineyards, as promised, is in the spotlight. They have put a fairly decent growth this time around, but let's understand what the expectation is from the D2C channels as well as what the outlook is for the second half. Rajiv Samant is the promoter, managing director and CEO at Sula Vineyards, joining in. Good to have you on board, Rajiv. To begin with, we did see that the elite and the premium wine really witnessed volume growth this time around. Do you think that trend will be sustainable for the second half as well?
Yes, I do believe that trend is going to be sustainable. It's a good time to point out how low per capita wine consumption is in India compared to the rest of the globe. So this is a massive opportunity, and it has a while to go to play out until we reach anywhere close to our potential. So we are now in our all-important Q3. This is, of course, the biggest quarter for the year. This is the quarter of celebration. This is the quarter of festivals, of holidays. So, of course, this is where it's the key quarter. And we are quietly confident that we're going to see some of the same trends move towards premiumization, double-digit growth in our own brands. Sula is becoming more and more an own brand company. We see it playing out in the second half of the year as well.
Rajiv, so are you joining us from Dubai or back home in Nasik?
Right now I'm in Dubai. Earlier I was thinking of going to Ahmedabad, but I couldn't make it, and now I'm not so sad that I didn't make it. So I think that the daily today is not a very happy day for us cricket fans. But in terms of wine, it looks like it's going to be a very good year.
Okay, when you say very good year, you've already guided for a 15% growth. Now, what does very good mean for you? Because when you are guiding for a 15% growth, that is something markets know. But now if you're saying very good, will 15 become 20? Will 15 become 25? What is that definition of very good for you?
Look, I mean, I think that 15% growth with margin improvement, even better than that. So better EBITDA growth than that is a pretty good spot to land up at. Today, I'm not going to guide for anything much better than that. I think even if we hit that, that's quite a sweet spot.
See this growth sustaining for multiple years, because that's the exciting part about Sula, that look, the wine consumption in India is at an embryonic stage, not even a nascent stage. It's an embryonic stage and it will continue to grow. So do you see that if one has to look at the 3 to 5 year CAGR growth for Sula, it is very easy to say that 15% is the bare minimum?
I think for our own brands, the premium and elite brands, so the premium end of the portfolio, that is definitely something that we're going to be targeting. You look at the opportunity today, Sula is the main change agent, and we are doing our work in pushing out consumption growth into non-traditional areas, you can say, for wine consumption so far. That's a task ahead of us. I do believe we can do it. So yes, I would stick to that for the premium end of our portfolio.
There are the differentiating factor between the wine industry and any other liquor company is that in the wine industry, the competition is intense. You got boutique wine firms, you got cheap wine which gets dumped into India, and now there is a talk of FDA coming up. Is that a valid fear that unlike a lot of other liquor companies which have brands which are limited and competition is limited and restrictive, in your category it's unlimited?
So I would say that, look, in most categories today, there's rampant competition. There's, FTAs do impact everyone. Sula has really taken the massive share of that sweet spot, which I would say is between 800 and 1500 rupees. We are by far and above the market leader. Our leadership in that is more than our leadership in the overall category. The discounting and the small players that you talk about is really sub 500 rupees. That's where we see it. That's why we are not concentrating on that segment at all. And when you talk about the imports, really where all the action is going to be is at above 1500 rupees. So you have a sweet spot, which is affordable, but not cheap. Slightly aspirational, but not expensive, not super expensive by any means. And Sula really has ownership of that spot, and we aim to keep ownership of that spot. And that is the 800 to 1500 rupee price segment.
How are you exactly going about beefing up your distribution, the tie-ups, have a pan-India kind of an imprint? Because a lot of times there are certain regions where it's a very local market as well. So what's your distribution strategy here?
So we are a national brand today. However, having said that, we face different challenges in different states. As you all know, excise is a very state-driven matter. So you have very high taxes in certain states on wine, and therefore you're going to see probably less of our presence in those states. And you have very low taxes on wine in certain states where you'll see a much bigger presence. But in terms of tying up with all India players, national players, we have the most robust tie-ups in the industry with the likes of Indian Hotels, the Oberoi Group, the ITC Group. That's in the big five-star category. We have tie-ups with all the lounge operators today across the country in the airport lounges. This is a big, huge growing market for us. Those are the kinds of things that we already have tied up. But there's always more and more big players coming in who we are always moving towards tying up with and always getting success in that.
What is the expectation from this harvest season given the unseasonal rains?
So it's looking very good for us. I must say that it's not been really unseasonal rains as much as like no rain in August and then good rain in September to make up a good amount of that rain. So in terms of our growers, we always are talking to all of them across. We take a poll. We have our data. It's looking good. Looks like it's going to be another bountiful harvest. That's going to be our fourth bountiful harvest in a row in terms of quantity as well as quality. So no issues at all on the supply side, the way I see it for the next year and a half.
Okay, good to know. And what about the outlook then in terms of the wine tourism revenue? What kind of target are you setting out for FY25? Can you do 100 crores of wine tourism revenue? Because that is something that you had suggested.
We will easily cross 100 crores in FY25. However, we see it as a whole business. it doesn't come out in our P&L just as wine tourism. So we also see the wine that we sell there, the DTC wine that we sell there, as also being part of it. And we're going to be close to 100 crores in our total wine tourism revenues when you take our F&B room revenue as well as wine revenue. We're going to be something like around 95 crores this year. So it's a significant part of the business. It's growing very nicely. There's a lot of interest in it. And we continue to always upgrade our product, enhance our product so that people keep coming back. And that's really something that's worked really well for us. Plus, this is the place where we really push tastings. And I'm very pleased to say that our tastings are up something like 30% on last year, which to me is a really important building block for the future.
Your margins have gone to 30%. Is 30% the new normal? I mean, barring 1 or 2 quarters here or there, is that something which you're aiming at?
Actually, Nikunj, I must say that's not something we're aiming at. We keep surprising ourselves on the upside in terms of margins. I have always said I want to get to being 1,000 crore company with 25% plus margins as soon as possible. Right now, really the focus is on driving that volume growth on that revenue growth side. The margins are taking care of themselves. I don't think anyone had thought about Sula coming to 30%. I would say that even if we get much faster to that revenue top line, but we're at about 27, 28% margin, I can definitely live with that. We should give up some margin in order to drive more volume growth in those states that have higher taxes. That's the way that we need to do it.
Would you map the competitive landscape for us? You've already spoken about imports. That look, that's in 1,000 rupee plus, that's in 1,500 rupee plus category, and that is not your mainstay. But local competition, boutique firms, how would you map the domestic competitive landscape for us?
So there are a number of, as you call it, boutique players. You have 1 or 2 that are probably more than 15, 20% of our size. The thing that really takes Sula apart from these players is our focus on quality since day one. And therefore, we really dominate 800 rupee plus. All these players are really fighting it out with what I see as unsustainable discounts in the sort of 600 rupee and less segment, which is not a segment that we are playing in at all. I mean, we are playing there, but we are not going to the level of the discounts that they are doing. So they are grouped there, and for them to move up in terms of quality, that requires a lot of focus, a lot of investment. That's not happening in the way that they would probably like to at this point. And so that's the way it's playing out. We have our segment that we dominate, where these guys are not a significant force right now.
Well, Rajiv, really appreciate your time. And next time, hopefully, we'll have you in our studio, not joining us via camera on Zoom from Dubai.
I would love that.
I'll look forward to that. Thank you very much, my friend. Always a pleasure to have you on the show. Let's take a break. And with the news that markets for the moment are not going anywhere, Sula, well, the company's in a sweet spot. The stock's done very well from its listing, but last couple of days, well, it's not the best performing stock. The best performing stock on your screen, Pratap Snacks, the block deal has been done 14% higher after that block deal.
Thanks for staying on with us. From one corporate voice then to another, let's focus in on IEX. It's been a pretty strong quarter for the company. Will the high volume growth aid margin expansion down the line? Let's find out. Rohit Bajaj is the ED, Business Development Strategy and Regulatory Affairs at IEX, and now joins in on the show. Thanks so much for taking time out. Let's just begin by talking a little bit about the kind of volume growth that you've clocked in, because that has been fairly encouraging. Do you think that we can see a further margin expansion owing to the operating leverage?
Yeah, good morning. So this last quarter was very good for us, Q2, where we registered close to 15% growth in overall volume terms. And after that, in the month of October, we have seen huge demand increase. So YOY basis, overall country's demand increased by about 22%, and we got lion's share of it. Our volume also increased by 20% in the month of October. So all in all, if I talk about first 7 months, we are at 12%, and going forward, as the supply constraint will further ease out, because November, December, January, February, these are generally the months where we have large supplies coming in. Not all the states are drawing, and this is a time when prices go down a little, and then states start to take advantage of the market. They leverage this low price electricity which is available on the exchanges and try to replace their costlier supplies. So we expect that going forward, we should be able to scale up this growth further. and take benefit of the supply constraints which are easing out.
Well, you already shown a very interesting 200 basis point kind of expansion in margins this quarter. If the volume outlook from here on is good as you are sharing right now, would it be coupled with higher margins as well, or they'll roughly be around current levels?
So margin, we are at a very high level already. So we believe that it is going to be at the same level or little bit on the positive side, because you know that the expenses are more or less fixed, and whatever increase in volume is happening helps us improve the margin. So not too much expectation on that front, but yes, volume growth will drive higher profitability and higher margins.
Margins, are they a function of the volume, or irrespective of the volumes you do, margins are going to be independent of that?
Margins are definitely function of volume. It is driven by volumes here.
There is a pattern which we've always seen, that winter demand is always higher than summer demand. Right now, the merchant power prices have really gone through the roof. So at a time when we are looking at uptick in electricity demand and a big uptick in merchant exchange pricing, how will that change your landscape from last year versus this year?
Yes, so it's not always that winter demand is more than summer demand. Generally, what we see, summer demand is little on the higher side, and then monsoon demand is also high depending on how good or bad the monsoon is. Winter season is particularly where we have demand coming up only during the morning hours and something in the evening hours also. Largely, if you see on an average, this demand is not very high. So what happens in these months is normally we see the prices going down. So till now, our average price at exchange is about 5.5 rupee. November price has come down to close to 4 rupees, and we expect prices between 4 to 5 rupees in months to come. So when the prices are on the lower side, state distribution companies, they try to optimize their power procurement cost. What they do is they have today, as we know, majority of the power is tied up under long term. And when they have so much capacity coming through or so much energy coming under long term, they identify which is the costlier one. So they replace that costly power with the exchange procurement, and which helps us increase our volume. So this trend we expect going forward will help us gaining in the volume. Though demand overall basis, it would not be very high. It would not be as high as summer month, but the demand would be there, and it will help us get more more volumes.
I'll take the clock back, and I have the number for Q3 FY22, and I'm looking at total volumes. That was 27.7 billion units. What you've clocked for the quarter gone by 16.5. It's almost a 30-35% drop in what you clocked, let's say, 2 years ago versus what you currently have clocked. Why is there such a drop?
See, 2 years back, what we are referring to was the COVID time, and this was the time when overall demand in the country was very low, and the prices were also at the lowest level. We have seen historically the lowest price during the time when what you are mentioning, and this is the time when all the states, left, right, center, they were replacing their power, and we were getting huge demand. Subsequently, what happened when all of a sudden we have seen increase in demand across the country? There were certain supply side constraints also emerged. You may be aware that imported coal prices were at all-time high level. The gas prices were also at extremely high level. So there was not enough supplies available. Last 6-7 months, or I would say last about a year, we have done a lot of groundwork within the country. State government has taken many initiatives. Today, all our imported coal-based plants are running. Today, coal production has increased by 15-16% in Q2 particularly. Overall basis, it has increased by 12%. And with all these things coming in place, we are getting more and more supplies. So that the comparison probably is not right, because those were 2 years when we registered almost 30%, 25 to 30% increase in our volume. Last year, it was flat. This year, we are expecting 15 to 20, more than 15% increase in volume on overall basis, on the annual basis. H1, it was already 12% up. Q2, October particularly, it was more than 20% up. And we hope that this trend will continue. We are working to ensure that this trend will continue for coming months also.
Rohit, you are also looking at introducing longer term contracts, 11-month contracts. Have you filed them with the CERC? What's the update there?
So very shortly, we are going to file it. Our internal preparation has been done. So till now, let me also explain you what it is all about. Till now, we have contracts which where the procurement can be done up to only 3 months. But there is a requirement in the market, particularly distribution companies, where they want to do some advanced planning and then buy power in advance to meet their seasonal requirement. Let's take example of Punjab, Haryana, all these states where they have agriculture requirement coming starting from June. So they want to do procurement somewhere in January, February. So 3 months window that we provide them is not sufficient. So now the new regulation has come. This is GNA regulation where you can take open access or you can schedule power up to 11 months in advance under short-term market. So what we are doing is taking advantage of the regulation which is there, which is very market-friendly regulation. We are going to apply very shortly, and we are hoping that by, let's say, January, we should be in a position to launch this contract. And if we are able to do that, then entire next year demand we should be able to cater to, because the procurement cycle starts somewhere in January, it goes up to March. And if we have right kind of 11 months contract at that point in time, it should help us in scaling up our volume in this bilateral market also. This is going to be a new segment.
All right, good to have you. Thanks so much for taking time out and joining in. That's the word coming in from the management of IEX. They are talking about how their volumes will grow further down the line. Margins as well will be what they clocked in around Q2. And as of now, they're not expecting any major expansion when it comes to the margin picture. IEX are nudging the levels of about 140. Let's get a move on then. And GRSE or Garden Reach Shipbuilders came out with a steady set of numbers. We are now joined by Commodore P.R. Hari, who is now joining in on the show. He's the CMD, a retired CMD at GRSE. Thank you so much for taking time out. It has certainly been a steady performance in Q2. Take us through what some of the key drivers have been for you, and will you reach your peak revenue within FY 24-25?
Morning, Aisha. For 4 quarters on the trot, our financial performance has been on an upward trend, and the Q2 results have been very encouraging, as you mentioned. We have clocked revenue from operations, it's 97 crores, year-on-year growth 32, and has seen profit after tax 80.74 crores, 37% increase. Now, both the revenue from operations and the PAT have been the highest ever in the history of the company. See, the key drivers have been the project maturity levels. We currently are executing 4 projects for the Indian Navy, comprising of 19 ships, and these projects are at a level where maximum revenue recognition is happening. Our current order book is around 23,709 crores, and these comprise, as I mentioned, 19 ships from the Navy, and these include 3 ships of the P-17 Alpha project, which are at a level where there is a production level where maximum revenue recognition takes place. To your question as to whether we'll be hitting the peak during this financial year, that is 23-24 or 24-25, yes, as I mentioned, we are on an upward trend. And the next year, this year, there is FY 24, FY 26, 25, and 26. We'll be hitting very high revenues, unprecedented revenues.
Given that we have an election cycle and a lot of decision making typically gets delayed 3 months ahead of the election, maybe a couple of months after the election, what would be the impact on your business and the future order book?
As for the current business, unlikely to have any impact at all, because the contracts already been signed. We recently won a contract for 840 crores from the Ministry of Earth Sciences for an ocean-going research vessel. The orders are coming in. As far as the future orders, now the major orders that are likely to come out, there is RFPs that are likely to come out, is for the next generation survey vessels, 5 ships from the Indian Navy. The cost is likely to be around 3,000 crores. The order for the RFP for the next generation corvettes, 8 ships, for which the A1 was accorded by the DAC sometime around last year. Here we expect the RFP to come out during the latter half of 24. So the election impact is unlikely to be there in neither the projects that are under execution nor the orders that are likely to come. In addition, Navy is also likely to come out with RFPs for 21 waterjet FACs, and also followed by the P-17 Bravo, the next generation destroyers, the mine countermeasure vessels. So these are all rolling projects where either AON has been accorded or the AON is being accorded. So the elections per se should not have any impact on the, let us say, the RFP coming out or the contract conclusion subsequently.
Are there any large deliveries which are there in next 2 quarters? Because if there are, that will definitely lead to a revenue uptick and definitely lead to a sizable income uptick.
Yes, we are currently executing a project of 4 survey vessels large for the Indian Navy. The first of the ships has already completed her trials, and the ship is expected to be delivered in the coming month, followed by the first of the anti-submarine shallow water crafts. Here we are executing an 8-ship project for the Indian Navy again, and the first of the ship is likely to be delivered during the last quarter of the current financial year. In addition, while of course these 2 projects will fetch us the respective revenue from both these ships, but what I am expecting more is from the P-17 Alpha projects. See, the P-17 Alpha project currently is at a phase where the equipment are going in and the outfitting has started. That is the point where we expect maximum revenue. So as I mentioned earlier, this year the revenue will definitely hit a new peak, followed by the next year and the next year.
Thank you for taking time out and joining in and giving us a perspective on the numbers, and you seem very confident going down the line as well that we will see your revenues over FY24 to 26 only growing from the current levels. Well, lots of stocks that are buzzing away in trade, Pratap Snacks being one of them. In fact, earlier this morning there was a block deal that took place. Let's understand a little bit more about the contours of that block deal, because the Mehta family, we understand, has sold some stake. We've got Vinny here to break it down for us. Vinny?
So absolutely, we have seen that around a 5% block deal that has happened in Pratap Snacks today. Now, what sources say that Mehta family is likely, who have sold this 5% stake in the company, they are not actively a part of the company. They do not take the main decisions, but yes, they seem like they have likely to have sold this stake in the company. Now, Mehta family, when you look at it, as on September 2023, held around 18% stake in the company, and now post the stake sale, they will hold around 13.59% stake. Yes, so post the holding, it will be around 13%. I beg your pardon, 13% stake is what they hold. They will hold 8.19% stake in the company. Other than that, the Sequoia Capital as well as Kumath family has not sold any stake in the company, is what we are understanding. And Mehta family also is likely not to sell any more stake, is what we understand from the sources. So let's keep an eye out on that. Mehta family will not be looking to sell any further stake, nor has the Sequoia Capital or Kumath family sold any stake as of now.
Okay, thanks very much for giving us those details. That is the latest with respect to the promoter stake sale in Pratap Snacks. Tell you what, we'll slip into a very quick break. Be right back. We've got lots of corporate voices lined up as well as chart busters when we return.